There we go, I'm gonna get. Come on, everyone. So some housekeeping. The next 6 Saturdays are midterm. I teach this class somewhere else, so the exact class will be. And so what I do for them, then I can do it for this class. I send it out today is I'm sending out, because for you, for sure, it's gonna be more theory-based. I'm sending out 100 multiple choice. And the multiple choice is gonna be an exam coming out 100. So they have that for review and they know what the questions they're getting coming out of that, right? So it's gonna be 50 out of that. So and for all the chapters. And then for the rest of your exam, it's gonna be like short answer. Because I focus on more on the theory on this side and trying to do statements. And this chapter on leases is definitely like that. There's no bunch of calculations, but more theory and what it is and how it is. So I'm gonna post that today because I have to travel midweek. So everything will be posted. I'm gonna make sure all the solutions posted for any homework that I gave so that you know what the solutions to those are. I am looking, when I look at the homework, I look to see what you did and make sure that you walk through the process. I don't grade it to say you get 5 out of 10 and all of that. Once you do it, you get, if you do all homeworks that are assigned, the assigned homework grade, you can get 100% of it. I just want you to do it so that you work it through. And then you get an idea of, okay, I don't know how to do this or this challenging, and you let me know, and then we do it in class. So I want you to do it for practice. And I normally give students a whole grade once they do it. So it's just to make sure whatever's assigned, you did it, because then I measure. If someone didn't do any, if they did half, then they get half, whatever's assigned.
I mean, because supplementing probably quality solution, right? I was trying to watch the, because I missed that last week, though.
Oh, okay,
I missed the quality.
not good.
I
So,
just need to do chapter 20.
all right,
Yeah, I
so,
did.
okay, so. What you could do for me, since send me a note on Monday to post it,
Okay.
right? Because that way I doing everything today. Because I don't want to leave it till the last minute. Because I writing all exams and everything. Because Miss Dean is gonna do the exam because I coming back on Saturday. So I doing everything today like that, so it's no hold up. So just send me a note on Monday and then I'll just post it. I'll have it sitting there, but then I'll just upload it. And any other questions? You told Miguel that it was poor quality.
No, I didn't.
Make sure tell him because
It's hard, I don't know how the people on Zoom can actually see it. I don't read it. I turn on my
Nope.
caption.
I
follow and then I have to record.
what I'll do, for Wiley, because I have the online resource, they have slides too. So I'll send the slides.
I tried to do Wiley, but I think it's a method.
Well, they'd have to do it through here, and I told them the next time they offer the course, offer it through that portal, because what happens, once you do it through them, then what I do is I will issue you a code, and then you could get it. That's how they do it. So you have to do it like the institution, do it with them and on and on. So but they do it, so you end up paying for the tax, you pay for the material, so same principle. So I think that's it on the housekeeping stuff. So the day isn't going, oh, I'm stuck in the link. Right, so today we are talking about leases. And textbook gets into a lot of detail, but there's some things I'm gonna highlight that I think are important, and then, that'll be it. So this may be a little shorter than the full time, you'll see. The first thing, yeah. So the first thing is a definition of a lease. So in the lease arrangement, you have two parties. You have the leasee. And you have the lessor. Okay. And the leasee has the right to use the property. And the lessor is the person who controls So I put controls, is that gonna make sense later on? Right, so one person has the right to use it, and the other person is actually the person who controls the property or the owner, right? And this is governed by a contract. Okay. And the contract is gonna have some terms, some conditions, like how long. So the contract is gonna tell you how long this arrangement is gonna exist. contract is gonna tell you payments that have to be made. Contract is also gonna tell you, when the property is to return to the owner. So payments, we call these payments, rental payments. Or lease payments. Okay. So we have two people, the lessor and the lessee. One has the right to use the property, the other one controls it. This is governed by a contract, and the contract normally tells you how long you could use the property for. It tells you the payments to be made, we call them rental or lease payments, and then when the property is to be returned to the owner, right? So that's like bare bones lease. We're not getting into any type of leases, but if someone said a lease, what is that? This is where we start in the lease arrangement. So people do this for many reasons, right? Because there are many advantages to having a lease. So when we look at the advantages, so why would someone do this? So one reason, you get fixed rates. So if I was the governor of Bahamas, and we have many buildings downtown, if I lease a building for 5 years, that means they can't increase rent on me because I have a fixed rate, right? And I know inflation, no matter what happens, my lease payments are gonna be the exact same amount, right? And I know I have the right to use property, I could do, you know, all the terms, everything, conditions, they remain the same for that fixed period. Because normally the fixed period is not a year, the fixed period tends to be 5 years or 7 years, and you get to use the property, right? Same thing with equipment. Like if you're a manufacturer, you have a machine that produces t-shirts, and it might be real expensive to own it. So you lease it and you have these fixed payments. So when you're selling your goods, you know that payment is not going to fluctuate that much. So you're going to have reliability in what you charge in your customers. And think about a hospital. A hospital leases a lot of those scan machines, a lot of things the hospital use are leased, right? If someone doesn't donate it, oftentimes it's leased. MRI machines, all those type of things, they could be leased. So a big advantage that they are fixed rates. The second thing is we say protection against obsolescence. Okay. So it protects us against obsolescence because if a newer machine comes out later on, we're not stuck with this old machine if we bought it and then can't do anything with it at the end. We have to dispose of it and do all kinds of stuff. So think about copiers. A lot of businesses have those heavy duty photocopying machines and equipment. Oftentimes they're leased, right? So if a newer one comes out and it could scan and do all kinds of things and go faster because of technology, you're not stuck with that old machine and old parts and all the stuff that can't use with that anymore. I remember being in the bank and we had, I wanted them to get rid of passbooks, right? And there was a machine that you put the passbooks through to print it. And they purchased the machine, right? They purchased it for the branches. And what happened, because of obsolescence, and people weren't doing that anymore, and there wasn't a market for it, when the machine broke down, there were no parts, right? So even if you wanted to do it and offer it as a service, you couldn't unless you could get parts, right? So when you lease equipment, you don't have to worry about that, because when the lease finish, here you go, that's your equipment back. If you want a new one, you could get it, you could do a new lease, or you could at the end say, here you go, and maybe I don't need to have that technology anymore, I do something else, it come for your machine, right? So that's another advantage of having a lease. So flexibility. So this is another big one, and definitely in the banking space, you see it. If you're a foreign bank and you come here, like RBC, FCIB, Scotia, private banks, if I lease a building, if I don't like the promise anymore, I can pick up and go. And I have that flexibility. If I own land, I own the building, then I can't just go, because I have a investment here. So leasing is a way people come, I don't like it. Or if you have a store, you sell clothing, I lease a space instead of buying a space and putting all the infrastructure in. I lease a space and see, does this location work for my business? I stay there a year, it doesn't. Go to another space. So flexibility is really big. Okay, why you would want to lease. And these three are the advantages to the person leasing. So that's the lessee. Okay. So now for the lessor. The one, start from A again. So you are profitable. Interest margins. So if I lease a building, I know, don't care what happened, I always can get my money. That's a lock, right? They're obligated to me. And when we actually talk about how these payments are calculated as the present value, that's what I talk about interest margins. You could charge a particular rate for your building, and you almost guarantee in your margin of profit. Now, if say we're in downtown and there's buildings that are being leased and rates go up, you might lose because you could have had a higher rate, but at least you lock in. If it's a downturn, you got to get your money. And they normally have provisions in them that someone just can't break a lease. Oftentimes they have to pay for a whole year. That's a penalty or something like that. So you are still protected. So it's definitely profitable from that. They say to the lessor a stimulation of sales. So if you think about equipment, and I think about photocopies in this space, heavy duty equipment like that. When you have leasing arrangements available, it helps regular sales because your product movement is out there, people using it. And the more people use it and see it, they may say, I don't just want to lease it, I want to buy this machine, right? So it could stimulate sales. In the United States, there are tax benefits to the lessor that you could get. And there's a high return on the residual value. So the equipment in the secondhand market, if it's equipment for sure, there is a high residual value because something used, people know it's proven. Normally when you have a lease arrangement, the equipment is well maintained. A big area on this is vehicles. In the US, people lease vehicles more than they buy them. And that secondhand market for cars is crazy. I think after COVID, they say more people wanted to buy secondhand than brand new, and you couldn't find certain models. So people in the US for sure with vehicles, this is big business. We don't do it here as much. They used to do it many years ago, like companies and government entities used to lease vehicles, like from NASA Motor and other places, executive, but they kind of now just buy the car. Because those car companies would lease it for a year or two, and then they sell it at a crazy price, right? And that's because there's high residual value. So advantages to each party, why you would want to do it. And it makes sense depending on your business. So some things from an accounting perspective that we care about, and we have to answer the question when we think about leases, is the accounting concern here is capitalization of assets. Why that's important is that if it's deemed that you are the owner or you have control, even if you're the lessee, you have to bring assets onto your book. And when you bring assets onto your book, you have to have depreciation expense. That's a big deal to your profit. If now you were just paying these rental payments and that's all you had, but now, because some way from an accounting perspective, they say, oh no, you have to capitalize these assets, then you now have this additional expense on your books of depreciation expense. So that's a big accounting concern, accounting issue that we discussed, and we can discuss it more in terms of how that's dealt with. So the last thing, just generally on leases, is things that you would see in the lease agreement, the provisions that would exist in the lease agreement. All right. So we talked about time, so the duration is often something you see. Duration. So that has to be identified. The rental payments or lease payments, that has to be clear. Also, what we call executory costs. Right. These are costs to execute this agreement. There may be some costs up front that are also included in the lease arrangement. I have to be clear who paid, what happens there. Cancelability. What provisions are there in this arrangement if I want to cancel? Are there any penalties or any things that I need to be aware of, right? So even from an accounting perspective, you need to be You need to have an understanding of, what the provisions exist relating to cancelability. Restrictions. Okay, another important element in the lease. So say people who lease buildings, sometimes they say you can't sublet to someone else. So if I lease this entire building and I leased it and I was gonna use 5 floors, I leased in 5 floors of the building, it's the whole building, and then I find that I only need 3. There may be a provision that I can't sublet that other floor. I saw that happen with, I think RBC, the building on Carmichael Road, where they have the headquarter thing. That was partially empty, and I suspect that it was because the lease arrangement couldn't be subletted. So your buildings, and when you walk into them and you're like, why they have this whole area here? Why the square footage here? Why not? And a lot of times it's because the lease agreement doesn't allow them to sublet, right? And that could be a big issue. The other thing is with restrictions, and this is to do with equipment, they may say the equipment you can't modify in any way. Or if you want to have repairs done on maintenance, you have to do it through our vendor, right? So all those could be restrictions on how restrictions in the lease arrangement. So the last thing is alternatives. Of the lessee termination. So at the end of the lease, there may be options that the leasee could buy it at a discounted cost. So that's what that is speaking to. So sometimes you could have options available. When it terminates, you may have the option to renew it for additional year, whatever it is, depending on if it's equipment or if it's building, and it may have alternatives. If I use a building for 10 years and it's an important location for me, and I know I want to move, and I'm actually making provisions to move, but it don't happen when I expect, I would want to make sure in this provision that I have some leeway, like a period where I could get an extension, even if it was for 6 months, without entering a full lease again, right? So those options for the leasee could be very important, because it does happen. People building a building, they've been leasing forever, and the building is just not finished when they expect. A hurricane happen, whatever, just a bomber. So that happens here. Things happen and people say, well, no, I'm not going to be ready but I don't want to be in a 10-year lease again, or I don't want to be, it's not going to take the whole year. So these alternatives for the leasee become very important. And also here is performance. So say and it'll cross over to this one, cancelability and alternatives. So say you got and says a photocopy or some big equipment. You see this with IT too, IT infrastructure. When they used to have those big machines, they don't have those big machines, but they still have really expensive ones now. And say it don't work out, or for your purpose to market ship, or what they promise, it doesn't happen. Then those type of things may be here or here if you want to upgrade, right? So sometimes you may have alternatives. So if it's equipment and it's coming close to the lease, a termination, you could upgrade to something at the same price maybe, but that's where you'll get some options there. So let's get into some of the accounting now. Any of you have been involved in any lease arrangement? No. It's very, very common. Especially foreign people like to do it, and they come here. They lease house, whatever it is. They just don't want that commitment. All the conveyance, all this other stuff, they rather do it. Some people do it forever. So it's a lot of leasehold arrangements we have in the Bahamas. So for leases, and I'm gonna separate it into two brackets now. So when we think about accounting, we have accounting that's for the lessor books, and we have accounting for the leasing books. Because their accounting is different. So when they enter a lease, the lessor is going to do one thing and the leasee is going to do something else, right? Or maybe similar. It just depends. So for every type of lease, we have to consider what happens on the lessor books and then what happens on the leasee books. And I say this because sometimes when you have questions, they will say you are the leasee. So when you're the leasee, you have to say, okay, what does the leasee normally do? What type of options available to the leasee? Well, say you are the lessor. So what options are available for the lessor? So I want to make that distinction clear. So it depends on who you are, what your accounting is going to look like. So I talked about ownership before, right? And control. So we have leases. We have a lease we call an operating lease. Okay. And we have a financing lease. Or finance lease. Okay, so there are two types of leases. So a finance lease, you have to meet one of 5 criteria to identify as a finance lease. If you don't meet any of those criteria, then you're operating lease. Okay, so that's how you think about it. If you meet a criteria as a financing lease, then that's what you are. If you do not meet criteria as a financing lease, you treat it like this, okay? So here, if you do not meet criteria of a finance lease. So if you don't meet a criteria of finance lease, you are operating. Okay. So finance lease, how do I get to be a finance lease? So the first one, so here, you got to meet anyone. Five criteria. So the first criteria, the lease transfers ownership property to lessee at end of lease. Okay, so if the lease is going to transfer ownership of the property to the lessee at the end of the lease, then it's a financing lease. Because really what it's saying is you doing a lease, but you're really financing it. Because if it was a operating lease, then you give back the property, right? So that's the thought process, right? So it's just like you could get a loan and finance the car, but you calling it a lease.
Sounds like a rent home.
Yeah. So really that's what you're doing, because you have no intention of giving this back. That's not the intent, right? So the second, and you'll see all the criteria speaking to that same concept. So the second criteria, lease contains a bargain purchase option. So again, if you have this lease and you say it's a car, and you say at the end, and say it's a high-end car, a Lexus or whatever in the market, if you had bought it at the time you leased it, it might have been landed, say 120,000, you leasing this car. And at the end, they say you could get the car for $3,000. That's a bargain purchase, because the market value of that car may be still like $20,000 or $30,000, but you could get it for $5,000. You finance it. That's what you're doing, right? The third one, the lease term is 75% or more of the property's economic life. Okay. So again, if you get most of the life out of this, it ain't coming back to the owner. You really used it. Anything else is not really gonna benefit anyone other than the person who's leasing it. 4, PV, the present value of lease payments present value of lease payments, it equals or exceeds %90 of the fair value of the leased property. Okay, so what you paying, you really, again, you taking ownership, you financing this situation. And then the last one is that the underlying asset or the leased property is specialized that it will have no alternate use after the lease. So a good example of this is if you lease a machine and the machine is producing a particular if you lease the machine, and the purpose of the machine is to be used in the Bahamas to do a particular thing, like say clean the ocean floor, say it was something crazy like. And it was designed for that specific purpose. When the lease ends, no one else could really use it, right? So really what you had was a financing arrangement to get that equipment to do that thing. Because they don't have any other use other than this specialized thing that you wanted it for, right? So again, you only need to meet one of these and you have finance lease, right? Because that's what you're doing. You have no intention of giving it back. You get, so this one, this one is very clear because you transfer ownership. So the first one is transfer ownership. Next one, bargain purchase option. Third one, we're looking at the economic life, right? This one looks at the present value of the payments. Is it equal to or greater than 90% of the fair market value of the property? And then the last one speaks to specialization of the equipment. Is it so specialized and specific that you wouldn't have another use for it? If any of those are met, then you have yourself a financing lease. So that's the first step with leases. You have a lease agreement. We are accountants. We have this lease agreement that that the owner entered into, if we are not the owner. And now we have to account for it. So the first step is to say what type of lease is this? Is this an operating or this is a financing lease? So that's the first question. Then we have to look at the components of the lease and determine, does it have any of these 5 components? If it does, then we have ourselves a finance lease. Now, the next step, third step, is to say, now we know whether it's an operating lease or a finance lease. We have an understanding. Now let's see the implications for the lessor and for the lessee. What does that mean for each of them? All right. So for so first, the finance lease. So we've gone through this process and we know we have a finance lease. Okay. So for the lessee, our entries would be, we'll have a debit that'll go to a right of use asset. And then the credit will go to lease liability. And this would be for the present value. So remember, finance lease is basically we saying that for the leasing, you just finance an asset, right? So you have control, this is yours. So really for the leasing, they bring in assets on their books, right? So that's why you have a debit to asset and the other side is the lease liability because this is for all the payments. So, you know, when you do the present value, if I have to make 10,000 payments every year for 10 years, what is the present value today? That's my obligation, right? And as each year passes, we reduce it until it goes to 0. So think about it like a bond, right? So on one side is the actual asset that we got. And on so that's the asset side. And on the liability side is the debt we can carry, our mortgage or our loan. That's what it's saying, right? So this is basically, I finance it, that's the loan, because I'm the lessee. And then you will have if you have a beginning of the year payment, so some leases, you have to pay a initial amount of deposit, right? So if you have to pay a deposit, then you will have cash. And this only happens if there is a beginning of year requirement, like if there is a beginning payment. On day one of lease. So day one, if there's a payment, then you have to pay cash, then there's you have to credit cash because you have to pay the cash, and then you owe, basically you have a loan. So that's what it's saying there. Because we are saying on this part, you meet one of these requirements, you really financing, and we can treat it as though you're financing. And at the end of each year, so this is the initial entry. Okay. So at the end of each year, your entry gonna be a debit to interest expense, and a credit to lease liability. But then you have amortization entry as well. So you have a debit to amortization expense, and a credit to the right of use asset. Okay. So this entry here is basically the depreciation, like you writing it down over time. All right, because it's saying that the value you get now the asset every year, it will reduce. Right. This interest payment entry is dealing with this debt piece here, the lease liability. Right, because just like think about it like a bond, you have the present value, and then at the end of year, the lease liability is going to be impacted by the payments that are made, right? Because you're still going to have your lease payments. So for the lessor, right? So this is a finance lease, right? For the leasee, that's the implications. So for the lessor, we consider this a sales type lease. Does that make sense? Yeah, because here they financing it. So basically you have a sale, right? You are, you financing it. And so it's just like, I think you said, when you, yeah, you do the installment payments, right? So you go to the furniture store, you get the whole bedroom set and you pay for it over time. They could say, I have a lease, I lease in furniture, right? But for the lessor, it's a sale. So we don't say it's a sale, we say since you have a lease agreement, the sale type lease, okay? So here, we know that what we're gonna have here on their side, we have a debit, and it will be the lease receivable credit is gonna be the sales. They can be a debit. The cost of goods sold. And a credit to inventory. Okay. And just like this one, if it had cash at the beginning, so say they had to pay initial cash, we would have a debit to cash and a credit to lease receivable. So this makes sense on this side as a sales type lease, because if you thought about if someone bought something from you on account, what would the entry be instead of lease receivable? It'd be accounts receivable, right? If I bought, if I sold goods to someone on account. Yeah, we'd have accounts receivable and sales. We'd have the same entry cost of goods sold and inventory. And then here we'll have, when they pay something, cash, accounts receivable, because this reduces. So the only thing they change here in the sales type lease is change, instead of say accounts receivable, they say lease receivable. Right? Yes, if they pay cash on the first day. So you record the full amount that they gotta pay us for this asset. Right? So the same amount, this present value amount can be this amount they have as receivable. Because for them it's a sale. On this one side, really is a purchase they finance. Okay. So that's how the first option looks. So that could be here. Now let's look at the operating one. So here, we have, so for the lessee, what they're gonna record here . So for the lessee and the lessor, they record in the same amount. That's one of the things. Same amount. Let's see. So. So the lessee here, instead of having this interest expense and this lease liability, right? Because it's gonna look different from them. What they're gonna have instead is they're just gonna have this lease expense. They're gonna have the interest. It's not gonna be part of their lease expense entry. So you're gonna have lease expense. Right? And whenever they make payments, it's gonna be lease expense and then cash. Or however they pay, whatever they pay with. Right? So for the lessor, The lessor now is gonna look more like a company that owns a property. So a couple things for the lessor. So one, they continue to recognize the asset on its balance sheet. So, you know, in this one, they treated it like inventory. So you have a sale, you sell inventory here. They're not doing that. They hold in the asset because that's theirs. And they can hold it on their balance sheet. They're gonna show it on their balance sheet as an asset because they still own it. Because for this one, no transfer, no sale is happening, right? The second thing is that they can recognize revenue each period. And they're gonna be lease revenue. So they can credit lease revenue. Okay. The third thing, they can depreciate the asset, the leased asset. And four, they would be the ones to recognize if there's any unearned lease revenue. So this will happen where if someone pays them, if the payments are made at the beginning of the month and they didn't earn it yet, exactly like that first payment. So this first payment, say they got a payment up front, then they'll have unearned lease revenue. So this look more like would be normally if I carry an asset and I just charging someone to use it, then that's why I get my income because I get revenue, right? So it's like rental. So that's why when we started, they say lease payments are rental payments, right? So that's how this one looking. So not a lessor looking like a lessor, and the lessee, all they're gonna have is an expense, right? Just like if I pay rent every month, that's my rental, that's my lease expense. Okay. So accountants love this. They hate this. So this one, everybody try to get their client to be this one, but it don't always work like that, right? And you got to be here. And we have a lot of guidance around this because people still try and duck and get here. Because this person don't want it on their books. Under any circumstances, they don't want not just accounting, but the depreciation part, because you get into this and this is the depreciation piece, the amortization. That could be hefty, depending on the type of asset that's being leased. You could have money there. Whereas it'll stay on this person books over here. Right? So different consequences if you are the lessee versus the lessor. So just to recap this process, so when we talk about leases, we have to know what a lease is, who are the parties to lease, because we have to identify who you are. We know that they're going to be terms. So if you got a lease for the first time, you have to look at it. What are the terms of this lease arrangement? Based on that, you could evaluate whether you have a finance lease or whether you have an operating lease. And then once you know what type you have, then you know what the accounting should be for each party, the leasee, if that's who you are, and then the lessor, if that's who you are. So some other things to think about. When you think about leases, some accounting, what they call accounting problems or issues. One, residual value. Okay. So they have computations there and they talk about guaranteed in the terminology. So you could have included in the lease agreement a guaranteed residual value. You could also have an unguaranteed. So these two make a difference because these impact the calculation of your lease liability. So if you go back to think about fixed assets, and remember when you depreciated fixed assets and they'll have a value at the end, that's what it's getting at, right? So imagine if you have a guaranteed or unguaranteed, so imagine if you have a guaranteed residual value, then there are consequences for each of these when you work on our present value. So this one could be really impacted in terms of present value if you have a guaranteed residual value. So they give you that terminology in there and they speak on the consequences. So for that, I want you just to know the terminology, what it is, right? I mentioned early executory costs. So this is some other accounting that we have. So these are normal expenses when you have a lease, and they could be things like property insurance, taxes. Right? And so again, when we look at the accounting, we have to think about how we handle it, right? And one way is you have a gross lease situation, or you have a net lease. Okay, so you could gross it up, or you could do it net of those items, executory costs. But again, when you have the conditions of the lease, all of that should be considered. So again, some more terminology. The last thing I'm going to mention is the sale leaseback. Here in the sale leaseback, we have a company, right? So you have the seller leasing. So here, so we have the seller, and that's the leasing. They transfer. So they transfer in the asset. To another company. And we call them the buyer, lessor. Okay. And then leases it back from this buyer so you are the leasing, right? You transfer an asset to another company, right? And we call them the buyer, lessor, and that company leases it back to you. So that's how you get to be the leasing. All right, that's what we call a sales lease back. So why that's important is that you need to know where control lands, right? So where you have, and we have accounting rules over the sales leaseback arrangement. So if this is a valid arrangement, there's specific accounting that is involved, and you actually have the opportunity, you can recognize the gain or loss, depending on how it flows, gain or loss. But you could also have what they call a failed sale. And when that happens, you have to classify as a finance lease. Right? So you have to make sure you get this right on how you do it, or else if you don't, it's deemed to be a failed sale and it's classified as a finance lease, right? So why this could be tricky and why we have all this crazy accounting and stuff around it is because imagine if I have a company here and the company that's the buyer, I own that too. Or I have shares in it. Then I could be perpetrating something to move costs over to someone else. So that's why in accounting, we have these rules around it because we don't want people trying to manipulate the accounting. And you could have that happening because assets are very expensive. Think about a hotel, right? Hotel is a very expensive building. You see them, you see like Bahama, I think how Bahama was set up. They had China Construction build the hotel. And I don't know if China Construction, I don't think they transferred ownership or whoever actually owns it. I think Exim Bank owns it, but I don't think they actually transferred ownership to Hyatt and SLS. They have an arrangement, and it probably is this type of stuff, operating lease. So you operate it, right? You don't take on the cost of the building. You just have an operating situation. But to do it, you gotta meet, you gotta make sure you don't meet the requirements of this. So same thing with Atlantis and these places, when you see it's built by one person, but someone else operating it on the top, then you have a lease arrangement. So they're the main things that I wanted to highlight for leases. So just as a reminder, next Saturday is the second midterm. And it'll be more theory-based. So we're gonna be multiple choice and then just some short answer questions, like where you just write based on your understanding. And based on the topics we have. I'm gonna send out, like I said, today, 100 multiple choice questions, and a multiple choice will come from that.
So for the practical section, will it be based on that?
It'll be based on theory of the chapters we covered. So like, if you are asked what is the lease and like describe the pieces, right?
So we
So
won't have to do any entries.
no, you're not gonna be any, there's not gonna be any journal entries or statements like, you know, you have to write. No, it's gonna be theory based. So it's just making sure you understand the terminology and application, right? So if you say like for this, what's the difference between a finance and operating lease? right? Or what qualifies as a finance lease? How do I know I have a finance lease? And then you just say whatever it is. Okay, so it'd be that type of, so we had deferred taxes, right? We had income taxes, we had revenue recognition. What is revenue, right? Is this included in revenue or is this not? Right, so that type of thing, like a short answer like that. So, like I said, definitely theory-based, and I'll give the multiple choice ahead, so if you go through it, you can see it again if you go through it. Yeah, but it coming from there. So that I'm sending today. And any issues with that, let me know sooner than later. So I could address it. That's it for us.
So you want us to actually know to post homework?
Yes, because I'm gonna post the ones, but not for 20. Because you said that's the one you wanna, okay, so not for 20. So just send me some on Monday. Yeah. All right, so that's it for the day.
Hi, good morning, Ms. Hunt.
Yeah, don't come often. People on it, I don't know. I just pray. You want to now?
Huh?
You want to now?
No, no, no.
Okay, how they come?